This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey.
So I recently had a client reach out with a question that maybe you might recognize. He said, I've got a friend who wants to move everything to cash because he's sure a correction is on the way. What should I say to him? Well, if that sounds familiar, it's because some version of this shows up in every single market cycle. Markets begin to feel a little frothy. Headlines get a little louder. Maybe there's an election coming up or some geopolitical mess. And suddenly going to cash and waiting it out sounds like the responsible adult thing to do. Well, let me say this clearly up front. Wanting to get out ahead of a correction is completely human, completely normal, because corrections and bear markets are real, they're uncomfortable, and they never feel routine when it's you who's living through them. The problem isn't fear per se. The problem is that the strategy most people reach for in response to that fear. So today I want to walk through why the move to cash and get back in later approach is almost always aiming at the wrong target, and what you can do instead that's grounded in data, history, and a little bit of self-awareness. This is the same perspective that I share in my books and in my podcast, History Lessons for the Modern Investor, but in a condensed practical form that you can apply today. So let's unpack this. First of all, why going to cash feels so darn good. Right? On paper, the friend's strategy might sound smart. Markets have recently come off historical highs. Why not just step aside? I'll sit in cash. I'll avoid that pain of markets declining, and then I'll jump back in when things are cheaper and when the all clear signal has sounded. Emotionally, that feels like you're putting on a seatbelt right before the car crashes. Underneath that feeling are a couple of very normal human tendencies that I talk about in my writing. By the way, if you want any of the books that I mentioned throughout this video or any of my other videos, simply text book, B-O-O-K, to 239-567-5477. That's 239-567-5477, and we'll arrange to get you a copy. First topic that I talk about in those writings is loss aversion. We hate losses more than we like equivalent gains. In fact, depending on the study you look at, we hate them 2.5 times as much as a gain. So losing $10,000 hurts a lot more than making $10,000. Indeed, losing $10,000 feels like losing $25,000 compared to a $10,000 gain. So pushing the cash button feels like relief. It feels like you're taking control and you're eliminating at least some of that possibility for pain. The second tendency is recency bias. Whatever just happened takes up the most space in our brain. If we've had a rough patch, well, it suddenly feels like the next decline is both inevitable and probably permanent. If markets have been relatively calm for a while, well, then we start to believe that calm is the new normal until it isn't. So let's put those two things together and we get a very seductive logic. Things have gone up a lot and bad news seems to be building. So I don't want to relive 2008 or 2020, and I'll just step to the sidelines for a bit. The problem is that markets don't reward that kind of emotional timing. They just don't. In my book, History Lessons for the Modern Investor, I make the point that it's not the calm periods that test us. It's the turbulent ones, always and everywhere. That's when we're most tempted to abandon a plan or to do something, even if that something is statistically stacked against us. So imagine a recent 20-year period in the stock market. By my math, that's 2 decades, and that's long enough to include booms, bust, crises, and eventual recoveries. You get a good mixture of all those things, probably a couple times within 2 decades. If you simply stayed invested in the S&P 500, we'll say in an index fund that tracks the S&P 500 over that period, through all that noise, you earned a solid long-term return, probably something in the high single digits in most periods. Okay, it's nothing magical, but it is a basic reward for putting your capital at risk. Now imagine, instead of leaving it alone, you tried to be a little bit clever during that period. You got nervous and you moved to cash for a while, and then you felt better, and then got back in when things looked safer. You did this a few times over that 20-year span. Well, here's what the data will show you. If you missed just the 10 best days in that entire 20-year period, 10 days out of a 20-year period, your return was cut roughly in half. 10 days out of roughly 5,000 trading days in that 20-year period, miss those 10 best days, you cut your return in half. And if you missed the best 30 days, your return over those same 20 years goes from a positive to negative. So let's recap that. Stay in the index over 20 years, you get a high single-digit return. Miss the 10 best days, you get a medium to low single-digit return. And if you miss the best 30 days, you get a negative 20-year return. That is the price of being just a little bit off with your timing. And here's the twist that really matters. Those great days, they don't show up in quiet, comfortable times. They don't announce themselves. In the data I cite in my writing, 6 of the best 10 days occurred within about 2 weeks of the 10 worst days. So think about that. The market's worst days and the best days are clustered right next to each other. The pain and the gain are neighbors. Now think about when most people bail out. They bail out after some of those worst days. And when do they usually feel comfortable getting back in? After some of the best days, once the headlines look friendlier. In other words, the emotional timing almost guarantees that you miss the very days that do the heavy lifting for you in terms of your long-term return. Let me try to ground this in a single concrete example. On August 24th, 2015, the Dow Jones Industrial Average fell 588 points in a day. Ugly. It's the kind of day that drives people to cash. 2 days later, the Dow was up 609 points. So if you jumped out on the down 588 day, how confident are you that you would have jumped back in 2 days later when fear was certainly still in the air? Remember, there was no headline that said, all clear, crisis over. The headline said, volatility spikes, investors nervous, more selling ahead. And that's the core empirical problem with the I'll just go to cash and come back later strategy. To make that work, you have to be right twice. You have to be right about when you get out, and you have to be right about when you get back in. And you have to do that around days that historically cluster tightly together. The odds just are not on your side. So let's pause now and connect this back to what your actual goals are. Okay, your retirement, your kids' education, your charitable giving. None of these objectives have changed just because the market had a bad month or a scary headline. The underlying engine of your plan is still the same. The underlying engine is how much you save, how long you invest, and the long-term return you earn by taking a reasonable amount of risk, whatever that means to you. Now, when fear creeps in, what usually changes is not the math, it's our tolerance for discomfort. In my writing, in my books, I spend a lot of time talking about the emotional side of money. Things like loss aversion, recency bias, and all the other mental shortcuts that quietly push us away from sound decisions. Going to cash in anticipation of a correction usually isn't a carefully considered strategic move. It's a pain management move. I don't like how this feels, so I'm going to do the thing that makes the bad feeling stop. There's nothing wrong with that. There's nothing dumb about that. But you want to recognize it for what it is. It's a short-term emotional fix that can create long-term financial damage. So if going to cash is the wrong answer, what's a better approach? Well, I like to frame it this way. Don't change your plan in response to headlines. Change your plan, if needed at all, in response to who you are. Here are 4 practical steps that line up with the philosophy that I lay out in my books, especially in history lessons for the modern investor. First of all, revisit the plan and not the news. If a normal correction makes you want to bolt for the exits, that's a sign that your portfolio may be misaligned with your true risk preference. The issue is not that markets are broken, it's that your mix of investments might be too aggressive for how you actually plan to sleep at night. A good financial plan, and ideally a written investment policy statement, assumes occasional bad markets. Remember, I'm a history guy. I'm not pretending that these things have never happened before. It doesn't treat them as surprises. It builds them into the expectation. So instead of asking, what's the market going to do next? Ask, does my current mix of stocks, bonds, cash, and alternatives still make sense for my goals and my temperament? Second, adjust your risk thoughtfully, not emotionally. If you truly can't sleep at night, it may make sense to dial back your overall risk, but there's a big difference between right-sizing risk and abandoning it. Right-sizing your risk might look like rebalancing towards a more conservative but still invested allocation. Maybe you reduce your stock exposure modestly. You increase your bonds or cash equivalents. You use fixed or fixed indexed annuities within a long-term framework. Abandoning risk looks like sell everything, go to cash, and I'll figure it out later. What we're talking about in the first examples are planned adjustments versus the latter, which is a panic sell. Third, use volatility as a rebalancing tool, not a trigger. Instead of trying to guess when a correction will start or end, you can use volatility as an opportunity to rebalance. That means trimming what's done very well and adding to what's temporarily out of favor so that you stay close to your target allocation and your target risk profile. Now, this forces you mechanically to buy low and sell high in small doses instead of chasing what just went up or fleeing what is going down. Fourth and finally, decide your rules in advance. One of the key themes I emphasize is if it's important, put it in writing. Agreeing ahead of time of what you'll do in a 10% correction versus a 20% bear market gives you some clarity of purpose when your emotions are running high. Will you rebalance at a certain threshold? Will you add new contributions or on a set schedule, regardless of what the headlines are saying? Will you do nothing unless your plan dictates a change? Write those rules down when you're calm, and then follow through when things get rough. The simple act of planning in advance can keep you from making big, often irreversible decisions in the middle of the storm. So coming back to my client's friend's original question, is it okay to move to cash and wait out a correction? Well, here's the essence as a recap. The fear is understandable, but bear markets and corrections are a part of investing. They're not a flaw, even though they never feel good. The solution of going to cash, however, runs head on into the data, because missing just a handful of the market's best days can cut your long-term returns in half or worse. You have to be right twice in a very tight window over and over again. So instead of trying to outguess the next correction, revisit your plan, right-size your risk, use volatility to rebalance, and decide your rules in advance. The bottom line is, don't wreck a good plan because it isn't perfect in the short term. If recent volatility has you thinking about big moves, whether it's going to cash or swinging for the fences, this is the moment to step back and revisit your plan, preferably with someone who can help you separate the math from the emotions. If you're working with an advisor, have that conversation. And if you can't have it with that advisor, get a second opinion. Ask, is my allocation still appropriate for my goals and my comfort level? If you're doing this on your own, consider at least getting that second opinion before you hit the panic button. Your future self, 10 or 20 years down the road, cares a lot more about whether you stayed broadly invested and stuck with a reasonable plan than whether you called the top of this particular market cycle. Now, if you want one of those second opinions, all you have to do is text GlidePath to that same number. That's GlidePath, GlidePath. And that number is 239-567-5477. 239-567-5477. Why GlidePath? Because that's my trademark process for reviewing risk and making sure that our families that we work with aren't over or under risked throughout their retirement years. Thanks for watching.